Welcome to the Plan Solutions Incorporated podcast, where we give facts and insight on the latest happenings in the world of economics, financial markets, and personal finance. Plan Solutions provides advice on a variety of financial topics, including investment management, tax preparation and planning, and retirement planning. Chase has 25 years of experience in the financial industry, holds a certified financial planner and chartered financial analyst designations, and has earned a master's degree in taxation and a doctorate in business administration. Chase has a passion for helping clients down the path toward their financial goals. And I'm Jason LaChance, and on this episode, we're going to discuss trend following during market uncertainty. Also, inflation moderated in January. Plus, we're going to discuss insuring a home in a revocable trust and a look at the Plan Solutions Incorporated office bulletin board. Mr. Armour, how are we, good sir?
Well, I'm stuck working from home because I've got COVID and I don't want to infect anyone else. But, at least I can be productive and the March basketball tournament's starting. So I should have, plenty of entertainment to keep me busy while I'm stuck on the couch.
Oh goodness, I'm so sorry. I'm a little ahead of you, so. Oh man. Well, hey, we got some great topics, and we're glad that you're well enough to talk about this on this episode of the podcast. So let's dive right into trend following during market uncertainty. As we've discussed on here, and it's something you bring up a lot, the stock market is forward looking. But we're having a lot of interesting occurrences lately. Not uncommon, but interesting.
Yeah, I mean, we had a really good January. We've had a fair amount of volatility in February, and so far here in March is, the market's down, but really has been bouncing around quite a bit. And I think that's partly because the market is forward looking. It's investors are trying to use the best information available to anticipate the future and determine what will happen. There's an old saying on Wall Street that investors buy the rumor and sell the news, right? So when it seems like something may happen, that's when they take action, and then when it actually does happen, maybe they move on to the next trend or the next thing that may happen. And so that's I think that's a big part of what's created a lot of the volatility. Is there's been a lot of speculation on what may be happening. We've talked about some of these issues in terms of, the disruption to the AI investment cycle and how that will play out. The tariff announcements and the uncertainty as to what that will bring, the government efficiency efforts and what implications, if any, that may have. But there's really not much in the way of hard data.
Yeah.
And so, it creates this uncertainty. I think it creates a variation of opinions, which is how you can see the market, be up in the morning and then down in the afternoon, right? Or vice versa. As different investors have different views, and some are buying and some are selling at different times. So yeah, it does create for a challenging environment. While, in essence, we basically are just waiting until we get more data in the future as to the direction things are heading or the impact that, some of these different, items in the news cycle may have.
Yeah, well, for me, one of the challenges is understanding what is solid information and being able to make an objective decision as I continue to try to educate myself more and more, understand the stock market. I'm going to guess that's probably a pretty challenging situation for many individuals.
Yeah, it is a little challenging. I think, when you read an article and they make these statements, it's looking at it and saying, okay, can I confirm this, right? If I was a fact checker, how could I independently confirm this? Is there a data set that I could go to that's publicly available? Does this conform to, some established economic theory, and try to put some context into it. And in some cases, you may find that, really there's no way to substantiate that data. It's more speculation and opinion. In other cases, you may go to the data and you say, okay, they make a point, but there's a good chance that the magnitude of this is not going to be as big as maybe is being claimed when you get that perspective. And then as we've talked about in the past, a lot of times what you get is it's kind of the multiple domino theory, right? They're saying, okay, well, this domino is falling, and that means this one's going to fall, and then this one, and then this one, and then this one. And by the time you get to the end, look how bad that is. Or, during good times, look how good that would be, right?
Mhm.
And you say, okay, yeah, if everything works out, exactly that way, and there aren't any other factors or variables that could come into to impact things, that may happen. But what's the likelihood?
Right.
Of all of those dominoes falling and getting to that extreme outcome, and usually it's pretty low.
Well, and the interesting part for me, I think of it in terms of movies and TV shows where, as far as trend following goes, is you don't always see the whole big picture. You know, it's always in a movie where they're like, ah, last week this was at 221. Now look at it. We better buy. You know, there's not. So it kind of paints this picture of, oh, is that how I look at my potential investments? And so it doesn't always give the total data and what is really going on in the overall big picture. I think that's one of the hindrances that for me has been a part of that education curve.
That's absolutely true. There's the old saying, right? There's lies, damn lies, and statistics, right? And I remember a college statistics class where we got extra credit for finding an example of deception using statistics, or not showing what was really going on. And I found a little chart. It was an inlay of a bigger chart in the Wall Street Journal showing like the most recent looked really negative, and it was about negative, but then you overlay the longer term chart and it's like a tiny little dip after like a really big run up, right? And it's
Right.
like, okay, what is the big picture here? What's it really saying versus what little piece of the data are they highlighting to make the opposite argument? And I got the extra credit, so it must have it must have held true to some extent.
Yeah, well, I know I've done that when I've hopped on, and it's like, oh, if I look at a 3 day average, that don't look too good. But then if I zoom out and I'm looking at a 2 year, 5 year for certain investments, like, whoa, this has panned out really well.
Yeah, and I think that's where trend following can come into play as long as in our opinion, the short-term trend following is just not effective, right? Trying to
Mm.
jump in and out, and the market can be so volatile, it can move so quickly on new data, new news stories, things like that. But the longer term trend, we use that as a risk management tool. And we especially lean on it during times like this where, the odds of being able to handicap the probabilities of all the different scenarios that could play out, it's very low that you're going to get that correct. And, we've seen other periods like this, COVID, the financial crisis, where trend following was one of the more effective tools, basically with the idea that you're, kind of zooming out from the short-term volatility that you're seeing in the markets, the immediate news cycle that's very focused on certain things, and saying, okay, let's take a little bit bigger view of what's been going on. I mean, as we've come into this year, we were seeing, solid economic growth, good year-over-year earnings growth, a good job market, inflation trending down, which we'll talk about in more depth in a minute. The Federal Reserve, biased more towards lowering interest rates, right? I mean, you could go on and on as to the really solid positive trends, and that was reflected in solid upward trend in the market. And so despite this volatility that we've seen, the question really has to be: is this just a healthy pullback in the market,
Mhm.
which they happen every so often, or is it the beginning of a larger decline? And I think as long as the trend following tool says we're in an upward trend, you have to assume it's just a normal healthy pullback. But having a tool like that is a nice luxury to have because it will tell you, it will signal when, okay, the market is shifting into a negative trend. There's maybe a higher likelihood that this is, going to be the big one or one of the big declines. And it throws out a signal saying it's probably time to look at reducing risk, protecting value, kind of hunkering down and waiting till things settle down. So that's how we've used it. We've used it quite successfully in the past. We know it's not perfect. There is no perfect tool, but it allows us to kind of navigate this type of environment, potentially ride it out for the time being, at least until it goes into a negative trend. But if it continues in the range where it's at now, ride it out until we can get some real information, some real data to be able to assess how things may be evolving in terms of economic growth, trade flows, currency valuations, all of those things that possibly could be impactful in the future, or could prove that maybe the magnitude is not as large as some are predicting, and it's not enough to really alter those really strong trends that we were riding coming into the year.
No. Is there anything else you want to add before we jump on over to inflation moderated in February?
Well, just that with trend following, it's a discipline. Unlike just kind of picking and choosing, and so it needs to be adhered to, right?
Mhm.
There's a tendency to want to front run a model, right? If you see the market going down, you say, no, it's getting close to a negative trend. Why not just sell now, right? Why would I take that next 1 or 2% of loss before I sell when everything's been going down and it feels like it's just going to continue to drop? But those models are built during more rational times for a reason, when you can back test them, and if you try to front run them, you're not really using the model, right? You're not going to get the full benefits. I mean, we had a time about a year and a half ago where on a Friday the model was within 0.5% of going into a negative trend. So naturally, and the market had been going down for about a month straight at that point, and it was like, okay, probably next week we're going to have to reduce risk. And so spent part of the weekend planning for that. Come back on Monday and the market was up 3%, ended up being up 6% for the week, and really just did not stop rallying through the end of the year, right? So if you tried to front run that model, you wouldn't have gotten the benefit of the model. In fact, it would have deceived you, and you really wouldn't have been able to call it a false signal because it never gave you a signal, right? You
Right.
anticipated the signal. And then it goes the other way. There will be false signals. That's part of the cost. There will be some periods where it tells you to reduce risk, and then the data comes in differently than expected, or the news cycle, or just investor sentiment changes, and the market moves in a different direction than you expect, and you may miss out on some return. I kind of look at that. That's like those are the years that you're paying an insurance premium, right? It's
Mhm.
costing you a little during the good times, but the reason you pay that insurance premium during the good times is so that you get the payoff and the result of reducing the losses in the bad times when you really need it. So we'll have to see how it plays out. We're gonna try and stay disciplined. We're not going to front run the model. We also realize that the model's not perfect, and we may take action to manage or reduce risk, and it may not work out. So we need to be ready to shift as well if the market moves back, moves into a negative trend and then back into a positive trend in a fairly short time period.
Yes, sir. All right, diving into inflation moderated in February, U.S. consumer prices increased just 0.2% in February, allowing the annual rate to decline from 3% in January to 2.8% for the year ending February 2025. We had previously talked about some of this data, so we're seeing a little bit of what was speculated start to come to fruition.
Right. Yeah. In January, right, we saw inflation tick up to 3%, and there was some angst out there. And as we had said, the downward trend was still in place, right?
Mhm.
Services inflation, which has been the big deal, was continuing to tick downward. But in January, we had seen an uptick in goods, mostly led by food and energy. But food and energy were still between that 0 to 2% range. That's completely normal and acceptable. And so we argued, that will fluctuate as long as it stays within that range and services continue to tick down. The downward trend is still intact. And that's exactly what we saw confirmed in February. The goods number came down mostly because energy prices came down, or at least the increase, the rate at which the prices increases, it came down, and so that allowed goods to put a little less pressure on the overall headline number. Meanwhile, services prices increased 4.1% year over year, which is still high, right? It's a number that
Mhm.
we'd like to see come down, but it's the lowest it's been since January of 2022. So we continue to see slow but steady improvement. Um, and it's come quite a long way since in services, peaked at 7.3% inflation rate 2 years ago. But it has been a very slow decline. Whereas goods, which peaked at an inflation rate of 13.9% roughly 2 years ago, those prices have fallen much faster, and we're up just 0.8% in the most recent report. So I think it's just a matter of time. The overall downward trend is still intact, but it may be taking, it's taking longer than expected, partly because those services prices have proven so sticky.
Yeah. Well, and as we talked, the Fed's, they're still aiming for that 2% target. So it is slightly higher than that. But are there other potential things that could lead to that downward trend not occurring or continuing to occur?
Yeah, well, I mean, we need to watch it. We've talked about inflation expectations in the past and how those have gone up. And inflation's an odd thing that it's often a self-fulfilling prophecy. If people
Mm.
think prices will go up, they will, take actions that will cause it to go up. So that's a risk. And then, as Jerome Powell, the Fed chairman, said recently in his press conference following the Federal Reserve Open Market Committee, they're kind of holding off on lowering interest rates further because they're not sure about what impact tariffs may have on the price of goods and the impact that may have on the market. So as we've stated, as long as goods prices are between 0 and 2% inflation rate, we're not going to worry about it too much. But if tariffs are sufficient to push it up above that, then you would maybe have to make an argument that long downward trend that we've seen has been broken, and then kind of dig in and look at additional factors to say, okay, what's likely to move the needle going forward.
And if that occurs, then the response usually is hold interest rates as is, potentially tick them back up again. What
You
his
know, if it's because if inflation ticks up because of tariffs, that's going to put the Fed in a little bit of a conundrum because obviously the Fed's job is price stability. They really only have one major tool at their disposal, which is to raise interest rates and slow economic growth. Now, will they do that? It's hard to say because unlike, consumer price-led inflation or even cost-push commodity-led inflation, tariffs tend to be a one-time inflationary adjustment, right? You get a tariff, it increases, puts some upward pressure on prices, but then, you don't get this kind of feedback loop like we saw when inflation was up close to double digits, right? We saw it just build and build and build as you had this feedback loop. That has not historically been the case with tariffs. So if the Fed saw inflation tick up because of tariffs, I wouldn't be surprised if they just held steady and waited to see, what the longer term impacts would be, as opposed to just the immediate impact that may show up in the data before they make any decisions to change their long-term policy strategy.
Okay. Yeah, the other question I had in off of that is then does that usually occur because when we think of tariffs, imported goods, that sometimes particular items aren't moving, for example, if it's a washer dryer set, maybe it's something that's already here, it's already in stock, so the price of that has yet to rise until they're having to get a new supply shipped in from overseas. Is my thinking correct there?
Well, it depends. I mean, there's multiple strategies that retailers could take, right? If the cost of what you sell goes up, then you know that the cost of replenishing your inventory is going to be higher. So you wouldn't necessarily, if you have existing inventory, typically you would mark it up immediately to reflect the new pricing structure, because otherwise, after you sell the existing inventory, you're going to have to come up with additional cash flow
Mm,
to buy the new inventory, right? So it's a cost, and depending on, your access to working capital and whether you have sufficient working capital, whether you borrow to cover your working capital, there could be added costs from that. So quite often, what you will see is a surge in buying, which we did in the last, in some of the preliminary GDP reports, we've seen imports really surge as people were trying to buy it before the tariffs took effect. And then typically they would, as soon as the tariffs take effect, mark those up to reflect the new pricing. So they're able to get ahead of it, and they're bringing enough money that then they have that working capital to turn around and pay the higher costs of replenishing that inventory.
okay. Thank you. I was curious about that. All right, let's dive into insuring a home in a revocable trust. I mean, we've talked about revocable trusts, and many people use them to protect their property, ensure a smooth transition of ownership upon their passing. But what do we want people to understand about insuring a home in a revocable trust?
Yeah, so if you have a trust, generally you want to have assets such as real property, right? Real estate, titled in the name of the trust. That's so that the trust can function properly and that you get the benefits of avoiding probate and the smooth administration of an individual's estate. But that can sometimes create some issues with home insurance payouts, right? And with the disasters we've seen, both here in California, but really a number all over the U.S. Obviously, there's a lot of people dealing with this, and you hear about some of the issues. And you could have a home that's titled in the name of the trust, but often the insurance policy will be in the name of the homeowner,
Mm,
right? And for the most part, the trust, the revocable trust, is a see-through entity, right? So the trustee is the owner. It's one and the same. It does create some legal challenges, especially for the insurance company, because if they don't know all of the terms of the trust, they don't know who they should be paying out, what the requirements are. So one of the ways to get around that is to name the trust as an additional insured,
mm.
right? So the policy is still owned or held individually by the homeowner, but by adding their trust as a secondary insured, that can really speed up the processing of claims and get away from some of these legal snags that some people have run into.
And what does somebody need to do when they carry this? Is it a secondary policy? Is it in addition to? Whom do they need to add to that policy?
Yeah, it's not a secondary policy. It's the same policy. It's just, adding an additional insured. So it's just kind of a notation on the policy that, I Chase Armor, hold this policy, but so does the, Armor Family Revocable Trust, because it
Mm.
holds the property that's insured. So it makes a clear delineation of, the pre-existing relationship that's there, which then makes it easier for the insurance company to say, okay, we know of this pre-existing relationship. We don't have to vet it at this point before we put out distribute a check. And of course, each insurance company is going to have different policies related to this. So really, it's one of those things where it's worth having a quick conversation with an insurance agent and saying, is this something I should do, that I need to do? Is it just maybe best practices, or maybe it doesn't matter, but it also doesn't hurt, and you can just go ahead and add it just in case the insurance company's policies were to change at some point in the future.
All right, well, let's jump on over to the Plan Solutions Incorporated office bulletin board. Got one item pinned up there this week.
Okay, so this kind of comes back to what we started the conversation with, about just the lack of hard information that's come out recently. In fact, we've been in kind of this weird period, which I think is partly why the market's been so volatile, where there just hasn't been a lot of information. We're pretty much through earnings season. There's a little bit kind of going on, but most of the days where you have a lot of companies reporting is done. We're not going to get any of the GDP data until the end of the quarter. We did just have the Fed meeting. We had an inflation report. Both, you could argue were positive. But otherwise, they're just one of those kind of dead periods where there's not a lot of real strong, solid information. And I've had a lot of people ask me, would we be sending out one of our special reports or white papers addressing the current state of the U.S. economy and the financial markets given this volatility? And the challenge there is, typically when there's a period of volatility or uncertainty, when we write those papers, it's because we're going back to the data. And we're saying, okay, we're hearing a lot of this speculation, we're hearing a lot of concern about different things, but let's look at what the real hard data tells us and make a case for why a certain path makes sense at that moment. Really don't have the ability to be able to do that right now because of the potential for the data to be changing or maybe not. So really, I think it's one of those periods where it's just you got to take a wait and see to get some real data. A lot of the data that we have is backward looking, so it's not as useful with some of the potential changes that may be occurring. And following back on tools like trend following or something like that makes sense in the absence of hard data. From our perspective, the challenge I think of any investment manager is you're going to be wrong, right? At certain times, you're going to make mistakes, or you made a perfectly rational decision, but then the market, the economy, the world just changed, right? And within a short time period, and that's reflected in the financial markets, and you weren't positioned well for that. That's going to happen. Our saying is the goal is not to always be right; it's to be right more often than we're wrong, and make more money when we're right than we lose when we're wrong. And if you can do that, generally you'll do okay. And so, we recognize there will be times when we will make decisions that won't work out. But the one thing that is really important to us is even in those cases that we will be able to explain objectively using, real data based on the data and circumstances that were available at the time that the decision was made, why it was a rational decision, even if the result wasn't what we wanted. And that's where we're kind of stuck right now. With the market going down, does it make sense to reduce risk? I can't really make a rational, fact-based argument for that, right? Because that data just doesn't exist. On the other hand, should we bury our head in the sand and just ignore it and hope it goes away? Well, that's not going to work either, right? So it's hard to come out and really make a case either way. And so, for us, as long as the market is still technically in an upward trend, we think the best strategy is to ride it out and continue to collect additional information as it becomes available. If the market goes into a downward trend, then that's telling us something about the potential of what that future data could be or what those expectations are, and history has told us that that's a good time to become more cautious.
Yes, sir. Yes, sir. All right, Chase, anything else you want to add before we wrap up this edition of the Plan Solutions Incorporated podcast?
Well, just to finish on that last part, as additional data maybe comes available, then there may be an opportunity for us to do a special report or a white paper when we can kind of connect the dots and point to a significant shift in data, or maybe that's affecting certain areas of the market to be able to pull it together and make it make a bit more sense. But until then, there's really not much we can do in that realm.
Yes, sir. Well, we thank you all for listening to the Plan Solutions Incorporated podcast. Of course, available on Apple Podcasts, Spotify. If it's your first time, please give the podcast a follow, leave a rating, a review, and if you're getting value out of it, share with someone else that you know will get value out of it. The podcast is also available on our YouTube channel. That's youtube.com/Plan Solutions, and you can follow along to a video form of the personal financial review, the written content that we discuss here, and enjoy it there as well. If you want to get subscribed to the personal financial review, make sure to send Katie an email. That's katie@plansolutions.com, and get subscribed today.
The views and opinions expressed in this podcast should not be construed as an offer to buy or sell any securities. The information may not be current, and Plan Solutions has no obligation to provide an updates or changes. Plan Solutions does not make any representation or warranty as to to the accuracy or completeness of the statements or any information contained in this podcast or any liability therefore, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed. Plan Solutions is not providing any financial, economic, legal, accounting, or tax advice in this podcast. In addition, the receipt of this podcast by any listener is not to be taken as constituting the giving of investment advice by any Plan Solutions associate or individual to that listener, nor to constitute such person a client of Plan Solutions. Any reference to a specific company or security does not constitute a recommendation to buy, sell, hold, or directly invest in the company or its securities. Market indexes are unmanaged and cannot be invested in directly. All price references and market forecasts correspond to the date of this podcast.
Plan Solutions is a registered investment advisory firm.